Gene Gard, Chief Investment Officer at Treasury. Today, I want to spend some time talking about U.S. Series I savings bonds, also known as I bonds. In the media right now, there's a whole sort of zeitgeist around I bonds that they're the one-size-fits-all solution to every investing problem. And the only drawback to I bonds, if you listen to the media, is that you can only buy a limited amount, $10,000 or $15,000 a year per person. I would say there's a lot of problems with I bonds. In fact, I wouldn't even own the things. And I'm trying to be provocative by saying I hate I bonds. I don't really hate them. I mean, there's nothing intrinsically wrong with them. I don't own them. I wouldn't own them. I wouldn't touch the things. And I wouldn't recommend them to the people that I work with. But with that said, I can understand why people might want to own them. There's nothing wrong with them. It's just that the people that are advocating them, I don't think fully even understand the drawbacks that they're overlooking when they invest in them. So, right now I think some big commentators like Susie Orman and some people like that are recommending them just hand over fist. And it reminds me a lot of the idea that was just recently in vogue that you can replace your entire investment portfolio with just one investment, and it wouldn't even be a target date fund or some kind of core fund. People were saying if you just buy the S&P 500, that's the one thing you need, and it'll solve all your problems, and you're diversified. And I don't believe in that either. You're not diversified, and recent performance, I think, has borne that out. But this is the new thing. This is the new hot topic, and I just wanted to provide some information to help you understand why I bonds might not be all they're cracked up to be, and in fact, you also may not even want them as part of your portfolio. So I have just a few notes here. So I'm just going to go through and sort of rebut a few points that are very prominent in the media today. The first thing is they're completely inappropriate for an emergency fund. What is an emergency fund? It's money that you need in case of an emergency. And if you're putting it away, you want to have access to it, right? Well, the problem with I bonds is if you put money into an I bond, it's locked up for at least a year. It's not like there's a penalty if you pull the money. It's not like it's some kind of a soft close where you can get around it. I mean, you just can't get the money for a whole year, which makes I bonds actually one of the worst things for an emergency fund. I mean, anything, even a risky tech sector fund would be better than I bonds for an emergency fund because you might lose half your money, but at least you can get at it on a daily basis if you actually need it for an actual emergency. Hedge funds, interval funds, those are the type of investments that have quarterly liquidity, and nobody would say that's appropriate for an emergency fund. The only thing worse than I bonds for an emergency fund is probably private equity or something where you get locked up for 5 or 10 years. But the point is I would never put money away that I needed for an emergency if I couldn't get at it for a whole year. The next point I want to make is that I just want to talk briefly about how I bonds work so you understand. So you put your money in, you get your principal back at the end, which is good, I guess. And in the meantime, the rate you receive on the bond floats. So the price wouldn't generally change if they were traded, but they aren't traded. They just sit in your account. But if they were traded, the price probably wouldn't change because the rate just fluctuates. So the way the rate is computed is there's an inflation component and then a fixed real return component. And the inflation rate is based on, we won't go into all the details of the calculation and the fixing, but it's every so often it's set for 6 months based on the CPI for urban consumers, which is the headline inflation number. And then on top of that, you get a real return component, which right now for I bonds is 0. So absolutely best case, you'll get CPI on your bonds, which I'm going to argue is not all that exciting. What I'm going to do is just to show you, if you do want to know more, a great place to do that is actually the Treasury's website itself. So I'm going to go there and just walk through a couple things to show you. What I'm trying to show is, okay, so this is showing what I was talking about. Right now the fixed rate is 0. Everybody's saying you'll get 9.62 right now on your bond, and that's true in an annualized sense, but actually you're only locking that in for 6 months. So really you're only locking in a 4.81% unannualized actual return for 6 months, and you're also locking in a rate for 6 months which you have no idea what it is. We won't know until it's fixed in sometime around October of this year. So you're not locking in 9.62%. You're locking in 4.81% for 6 months, and we'll talk more about that in a minute. But what I wanted to show is, and so this shows that right now the fixed rate is 0, and it's been 0 for a long time, or very low. Right when they were first issued, it was higher, around 3%. I might want that. I might want a bond that pays CPI plus 3.6% right now, but those aren't available. You can't get those, and you can't buy them in the secondary market. And what I wanted to show is, this is the point I was trying to make in this slide, is that you should be just as excited right now about I bonds as you would have been a few years ago. And you can see this 6 months it is paying 4.81%, but before this recent bout of inflation, which is very short, you can see these returns were pretty anemic. At some points they're even negative, so you don't lose money, but you just get 0 return. But the point is, at 4.81% right now, with the way inflation is, you should be just as excited about getting paid that as you were in 2013 when you got 0.59% on your I bond. So the point is, believe it or not, I believe, and I think the consensus is, that inflation is going to get under control. If you look at the consumer surveys, or if you look at the TIPS break-evens, everything indicates that we're going to get back to a 2 to 3% kind of inflation number just in a very short amount of time over the next couple of years. So the point is, if you're excited about 9.62% annualized, well, back here you should have been excited about 0.16% annualized, because it's the exact same thing. Once you take inflation into account, if you believe in inflation and you believe in real returns, those two situations are identical. You're getting the exact same performance. I just wanted to show one other thing. I feel like I'm the online police. I spend some time on message boards just trying to see what people are concerned about. Lately I feel like I've been the I bond police, because every time I see, it's like the claims are getting more and more bizarre when people talk about these things. And in fact, somebody linked a screenshot of this chart, and they were like, yeah, look, see, right now it's paying 9.62%, but look how good I bonds did for the last 10 years. I mean, the return's hovering right around 9%. I was like, man, that's not at all what's happening. What this is showing is if you bought an I bond during the periods listed here, this is what you'd be getting in an annualized sense for this, this 6-month period. So if you bought an I bond with 0 real return, you'd get that. When we looked at that chart before, where you saw that, and at the end, there's some of those that had 3 or 4%, and sure enough, all this chart represents is inflation plus whatever number is in this chart, which is completely irrelevant. If you owned an I bond with a 0% real return component, this is what your semi-annual interest would have been. This chart here, which you can see is not really exciting at all. So we talked about that. And here's my provocative, controversial statement. You're practically guaranteed to lose money in an I bond. And what do I mean by that? Well, first of all, you are probably not going to want to own it for more than 5 years. If you owned it for over 5 years, you would be getting exactly 0 real return in some investment that, with that long of a time horizon, could actually provide real returns over and above inflation. So let me just go back over here. So the point is, everybody loves I bonds right now at these kind of rates, but it's very unlikely that when rates get back down to these kinds of levels, which is entirely probable, people are going to be bailing on these things for the next one-size-fits-all hot investment opportunity, which who knows what it's going to be, but I bet it's not going to be I bonds. So just a quick historical aside, I just wanted to point out that this is a chart that's a little disingenuous just because the time period is so long. Nobody has a 100-year investing horizon, but the point is that stocks go up over time. A dollar turned into 32,000 in small cap, or 10,000 in large cap, or whatever. But really, the worst thing you could have done had you had these investments available to you in 1926 would be to buy the equivalent of I bonds. They didn't exist back then, but if you could have bought an I bond, you could have turned a dollar into $15 over almost 100 years, which you can see what you're leaving on the table by doing that. And sure, you might tactically be able to guess just right in the short term, and if you'd done it at the beginning of the year and avoided the stock market downturn, maybe you're a genius. But the problem is Again, the Treasury did this on purpose. The reason they structured it like this is so you can't hit and run I-bonds. That's why you have to hold it for a year. You lock in the first period when you buy it, but also you have an unknown second period. It's to weed out the people that are just trying to scoot in and out and try to time the market. They want people, I think, it's not that they even care, except that it's probably just a hassle to have big redemptions and subscriptions all the time. So they just make you have a little bit of uncertainty when you buy these things. And the longer the time horizon is, the less you would want to own something like that, in my opinion. You can't take the money out for a year, but if you take it out before 5 years, you're going to get a penalty where you don't get all your interest for redeeming early. So that right there, if you're only just barely getting inflation returns on your bonds, if they take some of that away, then you're going to get less than inflation and therefore lose money in real terms. And the main reason that I believe you're going to lose money with I-bonds, it's possible you'll get a penalty, but the main thing is that these things are taxable. So unless your income is very, very low, or you use one of the loopholes to use the money for education, I mean, there's a couple of very small carve-outs, but for the vast majority of investors, this is taxable income, and you can't put it in an IRA or a 401k or anything like that. So you're overwhelmingly likely to pay tax on this. So whatever your tax bracket is, you're going to get inflation, which is an exact 0% real return, and then you're going to get taxed on that, so you're going to make less than inflation. And if you believe in real returns, if you are earning less than inflation on an investment, you're going to lose money. And of course you might say, well, I'd sure rather have an I-bond since the beginning of this year because the stock market's down considerably, and I-bonds are principal protected and they have an actual return that keeps up with inflation. And that's true. And it's great if tactically in the short term you can somehow exactly predict when stock markets are going to have a downturn and shift back and forth like this. But in the long run, you have to want to have something that has a chance of beating inflation, that has a positive real return. Otherwise, there's not much point in investing. So if you did happen to time it just right, that's great. But I would ask you, when exactly are you going to pull your money out to take advantage of the run-up in stocks? And I would say nobody knows exactly what's going to happen, but it's entirely possible that recovery in stocks will start happening before the end of the year that you're locked up in your I-bonds. So I think that's another important point. Another important point. The next point I want to make is the rate is only good for the first 6 months. Headline CPI is volatile. So what I mean by that is, let's go back up here. Again, we talked about how right now, if you buy an I-bond, you're getting 0% real return. For the next 6 months, you're getting 4.81%. But then I have to stress, you're locking in after that an inflation rate for the next 6 months that we have no idea what it's going to be. And I would say it's even more problematic because, again, the number that they use for inflation here is headline CPI. It's not core CPI. And so headline includes food and energy, core excludes food and energy. And you might say, well, why would I care about an inflation rate that doesn't use food and energy? Because I consume food and energy, so of course that's an important part of inflation. And it absolutely is, but it's also, especially energy, is just incredibly volatile. So, you know, the core inflation rate right now is only around 6%, I think. And the headline inflation number is 9.62, as we've seen, that's locked in. But if, for example, if the conflict resolves in Ukraine or something like that happens, oil prices could fall dramatically very quickly, and the headline CPI number could suck below the core number very quickly. And so it's entirely possible, you know, in October or whenever this is, we could have an inflation print that, you know, core inflation could still be 6%, but the headline number could be 2% or 3%, or it could even be negative. And all that would mean is that there's still inflation in the system in that core number, but it just so happened that gas prices went down quickly, so it pulled down the headline number dramatically. So that's entirely possible. And it doesn't really matter, except that you're locking in that headline number in these bonds. So the point I'm trying to make is it's entirely possible, maybe even probable, that there could be an inflation print for the next 6 months of your bonds when you buy them, which is sort of artificially low, just like the print might be artificially sort of high right now based on gasoline prices. So I think that's something important to keep in mind. That when you buy an I bond, you are not locking in 9.62% for a year. You're locking in half of that for half a year and locking in something else that's completely unknown for the second half. Let's see. Yeah, so the next point, one thing I know a lot of people, it's just like we joke that in our industry, if you look at the academic stuff, there's a lot of comment on risk-adjusted returns and Sharpe ratios and volatility, and sort of the joke is that investors, Main Street investors, don't care about that kind of stuff. They just want to see the numbers, the big returns, show me the money. They'd rather have big return with a lot of volatility rather than smaller return with less volatility. But of course, big return with lots of volatility means there's big losses sometimes too, and then they don't like that. But that's sort of a digression. But the point I'm trying to make here, which is sort of an esoteric point, is that I do believe that asset allocation works. So, for example, our clients do have an allocation to stocks and an allocation to bonds typically, even if the expected returns to bonds isn't all that great. But all the academic research for 60-40 portfolios and stock and bond diversification and all that sort of stuff, the types of bonds that are being used in that analysis are traditional bonds with coupons that you can buy and sell. A lot of times they're issued at par, but then as rates change, the price of the bond can fluctuate up and down. And that's actually important because one of the main reasons you own bonds is so that in a market downturn, you can sell your bonds and rebalance into stocks and actually attempt to buy low and sell high, or sell high and buy low. And the problem is that with those type of traditional bonds, well, it's not a problem, it's a good thing. When the stock market goes down, often interest rates also fall, so bond prices go up. So you get appreciation and you get even more money to take from bonds potentially to rebalance into stocks. And you get that buffer in your portfolio where the drawdown in stocks is mitigated by the rise in the price of your bonds to some extent. And all the sort of research and everything is based around that. I bonds are not that. And there's two reasons for that. The main one is that they are not coupon bonds, which prices fluctuate up and down. They're floating rate bonds. You put in par, you get par back, and there's no opportunity to sell them for anything other than par in the meantime. So what that means is when you talk about diversifying away from stocks with bonds, there's nothing wrong with floating rate bonds, and they can have a place in the portfolio, but it's not a one-for-one thing where you're buying a bond here that is the type of thing that's analyzed in that type of analysis that can help you in that way in a stock market downturn. And even more importantly, again, if you do put money in I bonds, it's unavailable to rebalance back out of if things become more favorable with lower stock prices and higher bond prices. If you lock the money up for a year, you just can't get it. So that's a whole separate issue, which we've already talked about. The final point I want to make here is, I said it's unlikely you can buy a material amount. If you can, be careful. And what I mean by that is if you're, for example, a client at our firm, and you have a $5 million portfolio, and you call up and say, hey, can I buy some I bonds? Like, I really want to do that. Why don't you guys recommend that? And what I would say to them is I'd say, well, that's not something we can really directly help you with since it's all through the Treasury website. And I saw something that said buying bonds on Treasury Direct is like going to the DMV. Like, it's just very clunky and it's very difficult. And sometimes you have to go get medallion signature guarantees and to get set up bank accounts and put money in. It's just a nightmare from what I've heard. Again, I've never done it. But so what I would say to a client like that is I'd say, sure, go ahead. I mean, you're welcome to if you want to go through the hassle. It's not wrong. It's not going to really have a material effect on your outcome anyway. But the point is, it's only $10,000 or $15,000. So, or 20, if you have a spouse. So it's just, if you have a large portfolio, it's just not going to really make a difference and move the needle. I mean, it's fine if that's what you want to do, but it's not going to really help all that much. Again, you were talking about if you put in $10,000, that's $500 for the first 6 months. If you're lucky, maybe if it was the exact same, you might get slightly less than $1,000 for a whole year on one tiny part of your portfolio. The real concern is, sorry, and I said down there at the bottom, if you can buy a material amount, be careful. And what I mean by that is if your portfolio is small, where I bonds are a material part of your portfolio, then I actually would have serious reservations about you doing it because, again, if you only had $10,000 to invest to your name, you would really want to find something that has an actual chance of beating inflation in the long run. You wouldn't want this kind of bond. I mean, I've seen people, I've seen people that are like, well, I have this new baby, so I'm going to go up to the annual gifting and give this baby $15,000 a year in a custodial account. Obviously, I'm going to spend the first $10,000 buying I bonds for this baby, and what do I do with the other $5,000? And I'm like, it just makes my skin crawl, because if you're 1 year old and you have an entire lifetime before you need your money, the last thing you want is something that's exactly inflation or slightly less that you earn on it. What you want is something that's riskier and more aggressive and can be volatile, but has a chance of soundly, really beating inflation in the long run. So I can't imagine almost a worse investment for a baby that has a 60-year time horizon until retirement. It's just ridiculous. So the point is, if you have a bunch of money, it's not going to make any difference. And if you only have a little bit of money, you probably need to find something that's more appropriate for your long-term goals. So again, I don't really hate I bonds. Again, there's a role for floating rate instruments in people's portfolios potentially, but there's a number of issues, in my opinion, that make the siren song of I bonds not as compelling as many people say. So I hope this is helpful. If you have any other questions, please let us know. If you have other videos, topics we could cover, we'd love to cover them for you. And thanks for watching. I appreciate it.